Welcome to the On the Rise podcast, where we talk about time freedom, passive investing through real estate, finance, and mindset. Let's dive in. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice. I am not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. All right, welcome back On the Rise podcast listeners. Thank you again for jumping into yet another episode of the On the Rise podcast. So glad you're here with us again today. I've got another amazing guest with me. I have Efri Argaman. Efri, welcome to the show.
Glad to be here. Thank you for inviting me.
Absolutely. I'm looking forward to chopping it up with you. So interesting story here. So Efri is the founder and CEO of OwnEZ, which is a data-driven financial technology company dedicated to democratizing homeownership through innovative data-driven lending solutions. Efri, that is an absolute mouthful. Okay. And we're looking forward to you unpacking that, for our audience today. But before we get into kind of some of the nitty-gritty details, we'd love for you to share with us a little bit more about Efri, your background, your journey, what you're focused on today, etc.
Okay, so I'll try to summarize it because we can start back in 1967 when I was born. So I'm based here in Austin, Texas. And as you mentioned, what we're trying to do, or I'll start from the end, what I'm doing today, I think we present to prospective investors the sexiest, non-sexy investment opportunity that exists today, while we provide prospective home buyers that can't afford buying a home but have no access to conventional lending the ability to become homeowners. Going back to my history, so I'm an economist by education, did a very varied path of career, and at a certain point I was running a medical device company. 2009, a year after the 07-08 crisis, I found myself with a little bit of money and decided to buy rentals, single families and small multifamilies in the markets that suffered the most. And guess what? Very quickly, I found myself being a landlord rather than being an investor. So my dream was to be a passive investor, have a nice success spreadsheet and collect money. And all of a sudden, once I had multiple doors, I found myself having almost daily phone calls from property managers needing to deal with the burden of owning rentals. So this led me to think that there should be something else. Another thing that I visioned once I became a landlord is that there is a large population of people that on paper can afford buying a home, but they are become chronic renters. So in 2012, I left my day job, decided to make my passion into a profession. Did almost everything possible in the residential real estate arena, flips, rentals, new builds, everything. And around 2017, I started OwnEZ with the idea of converting what we call chronic renters to become homeowners.
Oh, that's interesting. I'm glad that you shared that kind of background, with me, Efri, because your background is actually a lot more similar to mine than maybe what we had talked about off camera. I got involved in real estate investing on the active side during the global financial crisis as well. Had pivoted to more of a passive, role in 2015, predominantly because my wife and I decided to double down on children, went from 2 to 4. And, I didn't want my 9 to 5 to become my 5 to 9 and consume my weekends. Right. And so became more of a limited partner passive investor. But, I'd love to really kind of, jump into it and dive into kind of the main, topic that I want to talk to you about today. And, as of the time of this podcast recording, the average age of a first-time home buyer, I believe, is now 41 years of age, which is remarkable because I remember my wife and I bought our first home at the age of 22. And now the average age is 41. So a lot of Americans feel like home ownership is slipping further out of reach. From your perspective, what are some of the biggest misconceptions people have about why that's happening?
Well, first of all, aside of affordability, which is an issue, obviously, I think that access to financing became pretty much cumbersome. The system has been built to meet certain patterns, and in our era, where when people either work in gig economy, they do not necessarily have W-2s. They might have an IKN run number rather than a social security number. They may not have high enough average age of credit history, or they just come from simply from a culture that does not consume credit heavily, that they not have no access to financing. So people are paying for their living, people are paying rent, but to fit into the patterns of what the current credit system demands and the way that it is structured, you have to fit in. So you have to go by a certain path. And, I look at my own career, and I'm in my fourth or fifth career now. I followed the same footsteps of what you have done with your career. I started as a CPA. I worked for a few years. Then I changed my career. I became an executive at a certain point. And then I decided to start my own shop and do real estate. And guess what? For several years, I didn't have a W-2, obviously. And my taxable income had to be analyzed, because if you have depreciation of properties as expenses on your 1040, guess what? You don't have much of taxable income, which is a good thing, until you go to get a mortgage to buy your own home. And then they say, hey, you don't make enough money, which is not true. So I think that some of the hurdles relate obviously to affordability, and especially, I'm here in Austin, and Austin saw a crazy rise in between 2020 to 2022, and now it balances down. So obviously, if you want to live in the middle of a high demand city, it costs a lot. But I think that there's still a lot of opportunity out there in the Midwest and in other places, and people are shut off from access to financing just because the entire industry changed.
Yeah, it makes total sense. I'm an avid multifamily, investor on the commercial side, mostly that kind of workforce housing, demographic. That's your traditional B class, renter that wants to live in a safe, affordable neighborhood, but they lack the down payment and the net worth liquidity, or debt to income ratio, needed in order to be able to purchase and live in a single family home. Taking that, what I just said, Efri, as well as, merging that with something that you talk about a lot, and that is democratizing homeownership, right? What does that actually mean in practice for the everyday working professional, listening to this podcast?
So in a way, we were trying to define different data points that are more relevant to this audience when we come to underwrite loans. So obviously, we are not going back to 2007, where you had to have pulse and to breathe in order to get a loan. The loans that we provide obviously are full doc loans, but we look into data points that are more relevant to this target audience. So, and just to give a simple example, if I want to predict if a prospective home buyer will pay the loan, I will look into how they behaved when they rented the property. It's more relevant than whether they just paid off the balance of their revolving credit card for their Amazon purchases. So my assumption is that if you manage to pay your rent for a couple of years in the proper way, you were not evicted, you paid the X amount of money, most likely you will be able to pay the same amount of money, or maybe a little bit more money for your own house. I am more I'm more cautious about the reasons why the conventional system rejects you. So you would be amazed to see how many people are shut off from getting a loan just simply because they didn't have a mortgage before. Doesn't make any sense. You want to buy your first home. Obviously, you didn't have a mortgage before. So if this is the reason for your decline, it doesn't make any sense. And if this takes your score down, the score is irrelevant anymore. So we developed an algorithm that takes into consideration data points that are more relevant to this target audience and make assumptions and try to predict the ability to pay, not only based on pure DTI or W-2s, because you may do really well working from home as a freelance on one of the platforms. But then obviously you don't have a W-2, but you make a lot of money. Or you may be a prominent rental real estate investor, and we don't have to take the depreciation of your property into consideration, even though it's on your 1040. So we developed a non-discriminatory algorithm that takes into consideration purely these data points. And then once you qualify, you qualify. And instead of scoring with a number, our algorithm basically predicts how much of a home we think that this prospective borrower can buy. And with that, they can go on the market and buy whatever home they want, and it's livable, obviously. And that's it.
I'm Zach Haptonstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investors. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
Now, I'd like to talk a little bit about kind of, where we're at right now from a market volatility perspective. And I want to speak specifically about, kind of being in, I guess I would call it a higher interest rate environment for where we've been relative to the last handful of years. I don't think interest rates are elevated very high if you zoom the lens out further and look over a 30, 40, 50-year period. But at least for the last several years, interest rates are higher. Interest rate volatility, certainly has been off the charts, lately, given some of the geopolitical and worldwide events that have occurred. When it comes to being in a higher interest rate environment, where affordability has become a major issue, for individuals, how does OwnEZ, your company, help adapt and continue to create value, for both the borrower and the investor?
So in that aspect, and now I'm going to sound like my dad, and it's horrible. As you mentioned, we have to zoom out. I think that the younger generation got addicted to easy money, which means because we live in the times that the stock exchange has been going up for a long period now. We're in a bull market for a long period, and hopefully it will continue like this. And interest rates, especially at the beginning of this decade, were nearly nothing. With the pandemic, the markets were flooded with cheap money, and cheap money is addicting. So guess what? Money costs money. And I think that, interest rate today, if you zoom out in perspective of history, are pretty much reasonable. As for OwnEZ, our challenge is always to balance between the need to provide decent yield to our investors and at the same time not to become predatory to our borrowers. So in that aspect, we obviously it's private money. It's more expensive than getting a conventional loan, but we keep a gap from the average mortgage rate that there is in the market to protect the consumer. Our loans are amortized over 30 years. Obviously, there are no prepayment penalties. And for many of our borrowers, it's a temporary solution until they can become qualified with a conventional loan or just until they want to improve their housing, or they have other sources of lending or financing. In reality, even though we amortize the loans over 30 years, the average life of a loan is within the average range nationwide, which is 7.8 years. On the investment part, and as I mentioned at the beginning, I perceive it to be the sexiest, most not sexy investment. We are actually providing a non-correlated, non-volatile, pretty secured investment opportunity that is balancing any portfolio. So we are providing, or historically we provided around 9% yield on an annual basis, and we managed to keep this pretty much stable. And if I compare this investment opportunity to other investment opportunities that are in the market, like real estate investment trusts or other investments that are correlated with the stock exchange, when you invest in REITs, for instance, the asset class that it's invested in can be very stable, but at the same time, if the market dives, the REIT will dive with it. So the benefit here is that we managed to provide a mortgage-based security, non-correlated to the stock exchange, not very volatile, with a significant premium on what other conventional mortgage-based securities are providing. At the same time, we do some good because we help families that became chronic renters because they were totally shut off from the conventional lending system, become homeowners, and this is basically the ignition for them. This is the starter for them. Many of our borrowers obviously will pay off the loan way before it is being amortized, and in this way, we're not trying to hide the fact that we're trying to make money here, but we're doing some good while we're making this money.
Makes total sense, that side of it as well. You're obviously solving a need, in the marketplace that people have. And I appreciate your calling out, non-correlated assets. And I would like to maybe zoom in on that a little bit more. From an investor perspective, what makes OwnEZ's, investment funds unique compared to maybe other traditional, real estate funds, maybe debt funds, private credit opportunities? What really makes OwnEZ different from some of those other investment vehicles?
So obviously, I think that we managed to find a way to balance between risk and reward here. It's always the challenge of risk and reward. So obviously, there's risk in any investment. So full disclaimer, this is a no zero risk FDIC insured deposit. But at the same time, I think that today we provide more than 100% premium over other mortgage-based securities. And we live with an asset class that, first of all, has medium level of liquidity. So there is a strong secondary market for our product. It's not volatile. And it provides some protection against inflation, because obviously we are bound to change. So the loans that we originate are in fixed rates, but we are bound to change the interest rate based on the interest rate that is in the market. So the benefit of joining into our investment, that there is already a portfolio that was underwritten in relatively high rate. So the last deductions in the interest rate actually do not impact the investment opportunity. The fund itself is a Reg D 506C. Obviously, we have a third-party administrator, and the entire investment is protected with a first lien position on the entire portfolio. I think in terms of managing the risk versus the reward here, we provide investors with a decent reward with hedged risk.
Makes total sense. I want to Efri, I want to get a little bit vulnerable here with you and share something that is of concern to me because I think it's of big concern to a lot of other individuals that have either young children or children in college or maybe that early 20s, crowd out there, especially relative to the average age of a first-time home buyer being 41. Let's speak specifically to that individual that, maybe feels stuck as it relates to their own children and overwhelmed by or discouraged, quite frankly, with maybe their children not being in a position to be able to afford a single family home themselves, at some point here in the future. What practical advice would you give, to that parent out there of a child to help that child really start to make moves in the right direction today?
This is my own problem. I have three kids. My eldest, she's 30. I have a 27, and I have a kid here at college here in Austin and in the university, and I have to give them this advice. So I think that at least the advice that I gave my kids is to balance between their consumption and investment, and to start to invest very early in their lives. So even my youngest, who's 19, he has a small portfolio that he cultivates by himself. And basically the purpose for that is to allow him in a relatively early stage to have sufficient funds to pour towards a down payment. I think that the advice that I would give such parents is to educate their kids financially, to look into real estate in a holistic manner. So one of the issues that many times we have is that when we underwrite prospective borrowers, they come with a vision of buying a nice mansion on the shores of a lake somewhere, and they end up realizing that they cannot support more than a decent 3-bedroom, 2-bath ranch in the Midwest. So I think it's all about expectations, and we live in an era that everything is accessible, everything is on social media, and you want to be like the other one. How you've seen their lives on Instagram, but Instagram is not real life. So my advice to my kids was to start small with whatever you can afford, and then grow from there, and capture equity. As much as possible, as fast as you can, start as early as you can. And in reality, my two eldest daughters started early with buying a very small investment property that they rented out. And as they grow, they capture some equity. So now they have something to show for. And also as they evolve financially, now they manage to have sufficient funds to buy their own house.
Makes total sense. I appreciate you sharing, that as well. And I think the two kind of important pieces of information that I gleaned from what you just said there is really number one, the younger generation needs to find a way to get properly educated, on, kind of, building wealth and maintaining wealth and growing equity and that sort of thing. But, second to that is, while the information is all out there for the most part, relatively for free for people that want to go search for it and find it, really the most important thing beyond that is to take action. Does that resonate?
Resonates, and it requires you have to be brave in a way. I think that I built my first home when I was 27. I knew nothing about building homes. I bought a book. It was before Gemini and ChatGPT and all of them. So I just bought a book, and I managed to buy my first home, which I own until today. And it was my best investment. Back at the time, I managed to buy a piece of land for nearly nothing. But, it required to take action, and it requires also the ability to absorb a loss every now and then, because we don't make money everywhere. It's a lot of trial and error. But I think it's crucial, and I think that the education system today actually avoids dealing with this because, people, it's always controversial in our era. And I think that kids should be educated very early to have financial responsibility. This is the major issue. And if we're circling back to preservance of wealth, which is important, again, one of the things that we had in mind when we started our funds, and I will go back to our history, when we started the company, and when I say we, it's me and my co-founder, Eric, we started the company in 2017. We knew upfront that we want to scale it up, but we did something that is unique. Yeah, both of us in the past, we managed larger companies. I took 2 companies public, and the path was really simple. We back at the time, we came with an idea, started a company, raised money, went public, other people's money, great. And this time we decided to do it in a different way. And actually we brought our own money, heart, sweat. And for the first 2 years, we invested our own money in building this business, and also also investing in the financial product that we created, because we didn't feel comfortable to go out and ask for other people's money. And what we learned in that essence is that when you do that, you become extremely more efficient. And it's not that bad flying coach. And obviously you can do lots of stuff by yourself, and you do not need a great big office with a nice statue and an awesome receptionist in the lobby. So we managed to build our business. Now we are raising our fund number 5 already after having 4 funds. And part of the mission statement that we carry to our investors is that we want to give them a product that will enable them to preserve wealth. Talking about the younger generation, with Fund 5, we made a decision to reduce our minimal ticket to $50,000 as opposed to $250,000 that we had in our with our previous funds, because we wanted to provide access to more accredited investors that may be interested in dipping their feet into the water and testing this vehicle for wealth preservance.
Makes total sense, and I appreciate you kind of sharing that. And with that, said, as we kind of wrap up here, Efri, I want to just say, obviously, I really appreciate the value that you've brought our listening audience. But for those that are listening that would like to learn more about yourself and really what you're up to, with your business OwnEZ, how might they make contact with you?
So 2 options. One is just go to our website at www.ownez.com. Or if you're out on the road, I intend to cross the western part of Route 66 from Tulsa, Oklahoma to Santa Monica, California on my motorcycle later in the month. And I'm a great believer that you have to balance your life. So if somebody is into it, I will be more than happy to have fireside conversations on the road.
Sounds good. Literal fireside conversation chats. Well, again, Efri, really appreciate your time with us today and the value that you've provided our listeners.
Jeremy, thank you for hosting me. It's been a pleasure.
Absolutely. And listening audience, thank you again for jumping into yet another episode of the On the Rise podcast. Look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the On the Rise podcast. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decisions, please consult with a professional. This show is copyrighted by the On the Rise podcast. Written permissions must be granted before syndication or rebroadcasting.